Welcome to the daily update, where I'll go over the action in the market for Thursday, December 19th, and we'll see how things look for Friday, December 20th. So, not the nice little bounce that possibly could have happened. Tried to start out that way, but it didn't last very long. We did have a higher open, and there was really a lack of buying that came in, and we chopped sideways, ended up going down and actually closing a little bit negative again. So we're still holding up in one sense, growth to value, discretionary to staples. The large caps, mega caps, even though they were down, they're still holding up the market fairly well, but we're not seeing like a V bounce out of the big decline that we saw on Wednesday. Now it is options expiration week, and Friday is going to be options expiration, and that can be a crazy day. That's for monthly options, and it's also going to be the end of the quarter. We're anticipating a real increase in volume, and we'll have to see a lot of options that were suddenly in the money or out of the money after Wednesday's session suddenly reversed. And this could really produce some maneuvering. And with the increase of volume, may see some shaking a little bit here. But okay, before I get into that, we're getting close to the end of 2024. I have a thing called the SPX Investing Program. We look at short, intermediate, and long-term type positions, and I go through technical analysis. I talk about mental analysis, and I deal with different strategies that you can implement in any kind of market environment. Feel free to check that out. I will be locking it down in 2025. And for the time being, though, you can go see what you think of that. There are additional videos that I post there. There's a link that will take you to the website, and there's a link that'll take you to a video that talks more about the program. And if you have any questions, please feel free to send me an email, and you do get immediate access to the videos as they are available. Also, the daily video, that's where I really focus on things. All of the other outside videos that I do on a weekly basis or on an as-needed basis, they're all meant to tie into the daily video. All right, let's go back and talk about what happened. It looked like, okay, we were looking to be up about 1/4% or so with a bounce, but it just didn't really seem to lead to much other than a higher open. But we weren't even able to get up to the daily pivot at 59.37. Then we just chopped around. We went above and below the 5,900 level. Now, just a couple days ago, we were at the 6,000 level. And then we just kind of drifted down. We saw some weakness going into the close, and we ended up closing right at the intraday low. We were down 0.09%, virtually unchanged, but still it goes in the books as a down day. And that impacts some of our end of day indicators because when we have a negative day, they switch over and look more negative. There's other indicators that we have that adjust based on the up and downward volume that happens. All right, we were still above average with volume, and we are now negative in the short and intermediate term. We are still positive in the long term. A lot of this still has fallout to do with not what the Fed did, but what they said and what they say they're going to be doing going forward from here, where they're gonna looks like they're not going to raise or excuse me, lower rates. And the market, as I've been pointing out, was already anticipating that. In the weekly video, I go through the probability of what is the Fed going to do at their next meeting and then the meeting after that. We knew that there was going to be 1/4% cut this time. And as of right now, if you look at into January, they weren't anticipating a rate cut at all. Now that always adjusts, and every day it works its way to more or less probability. But that wasn't necessarily a surprise. But the market still decided to kind of freak out. And the weakness that we've been seeing for over 2 weeks now started to come through and show itself in price instead of seeing this sideways correction type of a thing where we were seeing weakness, but the S&P was still holding up. Well, then everything kind of turned down, and we're still looking more negative right now. Interest rates continue to go up, and that's pressuring stocks. We're up over that 4.5% level with the 10-year yield. And here we have the Fed cutting rates while the bond market has rates going up. So this is what we saw when the Fed came in last fall and cut rates. that was the bottom for interest rates in the bond market, and then they started going up as the Fed has been going through this rate cutting process. So they're going in opposite directions right now. And then the geopolitical things, which don't seem to have an impact, but we're coming closer into Christmas, and there's all the political things going on in the US and around the world. That could always come in and have an impact on the market. But it's lately, it seems like no matter what happens, it may be some kind of a short-term reaction, but it doesn't really have much of an impact. And I still look at oil every day, but I stopped showing it in the video here because it's just kind of chopping around that $70 level. We're a little bit under it right now. And so we just want to be aware because this is a time when people spend with their families, they have parties, they're focused on other things. And so you have to watch, okay, what's the government doing? What's going on geopolitically? What, the whole drone thing, the whole distractions that are constantly going on. There's things under the surface, and they use these times when people are distracted to try to do something that's like, wait, when did that happen? So that can also happen at the market level as well. I showed this yesterday, but it was a chart put out by Edward Yardeni. This chart was then posted at IsabelNet blog. And this is just the same chart. And by looking at this dot plot here, this is why the market is kind of freaking out, where they're anticipating rates not being cut anymore and kind of staying higher for longer. I don't use these kinds of charts myself, but some people find them rather useful. Okay, so some comments. Mega caps outperformed early. It looks like, okay, they're going to come in. We're going to see these big mega cap stocks just see this nice little bounce and come up out of that. It didn't last long. Kind of exhausted itself, and then they ended up underperforming by the time we got to the close. The semiconductor weakness, and I'll have some charts later on to show that, it's still continuing, and we're watching that because that's a critical area of the overall market because that feeds into the tech sector, and the tech sector feeds into the broader indexes. And then the Bank of England and the Bank of Japan ended up leaving rates unchanged. So we have the Fed doing their stuff this week. Europe was last week, and then England and Japan were also this week. We still have a confirmed Hindenburg Omen that's on the books, and then a very long list in the short term. Now, we treat this more as oversold than momentum because the long-term trend is still positive. And so when we get overbought and we're in an uptrend, okay, that can ride out for a while. We are more just focused on this when the longer term trend is still positive and then the short term trend becomes extreme negative because we quite often tend to not stay that way for very long. Plus, we're also coming into it should be a period of positive seasonality. It just hasn't really seemed to materialize yet. But here on the short term, a very long list here. The 20 period exponential moving average right on the S&P itself. The Stochk RSI, the Williams percent R, CCI 14, 20, and stochastics. These are the usual indicators that we see when we're just showing momentum one way or the other. Then we also have the force index. That's been on the list for a couple of days now. The standard deviation chart. We're into that -3 channel, which means we went down pretty far, pretty fast on Wednesday. Didn't work any of that off on Thursday. The percent B, which now that's 2 days for this indicator, tends to not stay on this list for very long. The short-term RSI based on 9 periods, we're still far away from the 20-period moving average. We just sliced through it on Wednesday, and we're still kind of far away there. And this is interesting too, the 20-period simple moving average study, and I have some charts to show you that one. Intermediate term, also seeing a long list here. A new addition is the CMB composite. We're getting extreme negative there. The VIX, even though it came down, even with a down day, because we were getting a really high reading there, it's moving very fast right now. And I base this around a 9-period RSI on there. And then the 50-period exponential moving average on the S&P. So we have the 20-period in the short term, the 50-period in the intermediate term. The advanced decline ratio, short term, is still extreme negative. And I thought I took this off here. The Stochk RSI, which is a short-term indicator, The McClellan oscillator. Again, something could be developing with that, but it hasn't really come through to price, at least yet. The PMO studies, a new addition now is the Swenlin trading oscillator, the ultimate oscillator, which is getting extreme, and then the 50 period moving average study. And I have charts of all of these to show you, and I'll go through what I'm seeing in these charts. So the Fed did come in, they cut rates another 1/4%, and now they're going to pause rate cuts and they're increasing their outlook for inflation and they're decreasing their outlook for unemployment. So that shows economic strength. The economy seems to be holding together from that particular perspective, but it's also more inflationary, and that's what has the market concerned. The dollar was up again, and interest rates were also up. We're at 4.57% with the 10-year yield, where we were at 4.49%. And we were already high. When we got into the 4.3 area, the market was already concerned about that. And interest rates are still going up. And until they can really start to come down, stocks are going to have a difficult time going up. We're still uninverted with the 10 to the 3 month and the 10 to the 2 year. I'm going to keep an eye on that. I'll watch them over the weekend. If What I'll probably do is drop this from this particular slide because I'm sick and tired of it. It's been 2.5, almost 3 years of saying this without anything really changing. Because usually this is more shorter term. We've had these inverted yield curves now for much longer than we've ever seen before. But then we never had a complete shutdown of the US economy and all the stimulus coming in and the crazy things with COVID. So in some ways, yeah, you can look at things and compare them to what's happened in the past because history does rhyme. It may not always repeat itself, but then we also have some unprecedented things that the market's trying to put in a little box and figure out why it's happening, where it's actually kind of unique to things that we've seen before. Sentiment, we're all the way down to 23 now. So we're negative, but we're getting extreme negative now. So you could still make a really good case. When you look at the short and intermediate term list, sentiment's getting extreme negative, and we're dealing with some interesting support levels. The market is set up potentially to really bounce up out of this. We just haven't seen it yet. And we may not see it on Friday. It may, if it does end up happening, it may go off into next week. But even though we're negative now and we're focused on that, we're looking for reasons why the market may turn and go back up. Okay, and then we're negative with our trend. The ADX is actually getting stronger. It's above its moving average, and the red line's on top. And I'll show you that chart as well. And then with the down day, even though it was almost unchanged, we're still negative and the momentum is negative. All right, so this was kind of a big day for economic reports where we had the weekly jobless claims at 220,000, less than the 237,000 they had expected, and down from the 242,000 we saw last time. This is showing strength. We were getting a little bit concerned there. The initial claims were starting to go up. Now they're starting to come back down. The continuing claims, not much of a change there, down just a little bit from what we saw a week ago at 1.874 million. Last week we saw 1.879 million. You know, there's no point in that number. And then the third reading for GDP for the third quarter, this was actually a little bit of a surprise. It came in stronger than expected, which is suggesting growth in the economy. Last time it came in at 2.8%. This time it came in at 3.1%, and they expected 2.8%. So that was a little strong. But then we come out with the deflator. This is the inflation component. It didn't change. 1.9% as expected, and what we saw last time there. The Philadelphia Fed Index, more specific to the Philadelphia area, minus 16.9. They thought it was going to be positive 3. Last time it was down 5.5. Existing home sales, a little bit stronger than expected at 4.15 million. They expected 4.1 million and up from the 3.96 million that came out last time. Leading indicators, up 0.3%. They thought it was going to be down 0.1%. Last time it was down 0.4%. Okay, here are some charts. And I don't have everything to show for charts, but I do have the major ones here. This is real GDP. That means inflation's being taken into account, and the deflator on a quarter over quarter basis. GDP itself is the blue line, and that's still looking positive there. The deflator is actually coming down a little bit on a quarter over quarter basis. Personal consumption year over year. So people are taking in more things. So that's going up. And the net exports actually seeing a little bit less of a negative number here. So that's showing a slight improvement. And then year over year with GDP, it's down from what we're seeing previously, but it's still positive. And that's the takeaway for right now. You can make a case that we might go into a recession at some point, especially after the new administration comes in and takes over. We're seeing modification, a lot of the economic data that's been coming out, and it may really shift over and look more negative. And there's these little games that they play, with all the different things that go on. Well, it can also happen with the economic data as well. But so for right now, the positive thing is that we're above zero with GDP because if we go negative with GDP and then that happens for 2 quarters back to back, that's a recession. At least that's part of the overall definition. Then the Philadelphia Fed manufacturing, it was negative last time, but even more negative in the latest reading here. This is LEI, the leading economic index or indicator, where we look at the index itself. That's the blue line, where it's just ticking back up a little bit here. And then this is the coincident. These are more how things are looking right now, and this continues to go up. So that's looking more positive. And then this is more annotated here. We're coming back above this red line. When we fall below that, typically that's when we go into a recession. And you can see back in 2008, that's what happened. That's what happened, of course, with COVID. Well, we fell below the red line, but we never went into a recession. And now we're seeing some improvement here. But there still could be a recession, but it didn't materialize this time. And then existing home sales really shot up in November here. Then weekly jobless claims really came down where it had increased in the previous week. We're still going up with the 4 week moving average. Continuing claims rolling over a bit here and coming down where it went back up in the previous reading. Now it's starting to go back down. And just to get some context, we show in red, these are the initial claims, blue, the continuing claims, and then the latest reading on unemployment. They're on different scales, but this just kind of puts them all in one place. And then looking at the real investment advice, home equity ownership against valuations of the S&P. And that's been a problem, but it's been a problem now for a few years that the S&P 500 is overvalued, that it's expensive. But people don't seem to mind as long as the earnings are going up. And this just compares folks at a household level that own stocks, and this measures the black line is the percent of financial assets. And that's pretty high. It's up into the 40% range. And then real total return valuations, where these continue to go up. And it just kind of shows the stock market is still a really good way, even at the individual level or at the household level, to build wealth. Okay, and then third time's a charm for Bitcoin. Who knows? Had a massive run up in 2017, and this is when it became all the craze. And I was getting emails and messages from folks, "Oh, should I get into this? Should I get in?" They don't know anything about it. All they look at it like a lottery ticket where, "Oh, I could just put $10 in and get $1 million back." Just totally unrealistic. But then that just compares what are the returns going to be? This is so far in 2024, and then will it continue to be positive in 2025? And I don't deal with Bitcoin or any of the cryptocurrencies in the videos that I do here, but I keep an eye on it and I watch the market even over the weekends when the stock markets are closed, but the cryptos still keep trading. And looking at the equity valuations, they're higher than the macro. That's the big picture would normally suggest, and we're just seeing this as another overvalued type of situation. But you can see this goes back years here. So we've been in this situation for a while. 10 largest stocks in the S&P 500, they account for over a third of the market cap. That's why we watch the mega caps. That's why I have a number of different charts later on in the video. We watch these things. I don't actively participate in them, but we keep an eye on them because they have a real impact on the S&P. And right now, as of the time this chart was created, it was 38% of the market cap, the total value of the stock market. 38% of that are the mega caps. And then this is what I've been pointing out here, and this is another chart from Bloomberg showing that we've been holding up okay with the S&P, but market breadth. This is advancers versus decliners. It's just going down, down, down. And this is even before Thursday's session. This is after Wednesday's session. And so I try to really stay on top of this. This is one of the internal measures that I look at where we're seeing the S&P holding up and very close to an all-time high, but it's only a few stocks that are really driving that, kind of like what we saw back last summer, because most stocks are declining currently. And then looking at privately owned housing units, and because we had some data that came out here, and we're kind of chopping sideways for right now. When we see a real decline, that quite often will happen before we go into a recession. Well, we're not really declining at this point. We're not really going up either. And then because we had retail sales earlier in the week, this has been a bit of a concern, but retail sales still seem to be holding up. When we tend to level off, because people still need to go buy stuff, we can still go into a recession anyway, and then leveling off, recession, and then a decline in retail sales. Well, we've been kind of level, but we're starting to go back up overall here as retail sales are still doing fairly well, suggesting the economy is still doing okay. I didn't spend any time on Twitter. I'm busy doing other things right now. But it was kind of a disappointing day with the big decline that we saw on Wednesday. It looked like, okay, we were going to gap to the upside and then just see how much of this we could get back. Nah, we put in the high right at the open. And then we just kind of drifted down. We went above and below this 5,900 level, and not really much happened. And then we just drifted lower going into the close and then ended up closing right at the intraday low, a little bit below Wednesday's close. And we're down again. If you look way over here on the right, this is the initial overnight session. The futures are weak currently as I record this. We'll have to see how things play out. And remember, it is going to be options expiration. So that can make it kind of a crazy day there. But when you look at this, even though the blue line has been taking a hit, it's still well above the red line. It's value that's really getting smacked right now. The red line's really going down. So when you take this, when you compare them with each other, we're still holding up here with on an intraday basis, growth is still outperforming value. This is still holding up too. We go back to the end of November, we've been going up with the growth to value ratio with the S&P, not screaming to the upside, but it's holding up for right now. End of day, we were actually up with growth where we were down with value, down less with the mid caps and down less with the small caps. And this is under the surface. And this is showing the potential of some strength. It just hasn't come through yet into what we're seeing with price. So we look at the small cap growth to value ratio. This is the end of day chart. Positive seasonality. Get into small caps now. They're just magically going to go up. And look at how they're going down. But the growth to value ratio is holding up and in an uptrend here with the small caps, also holding up with the mid caps, even though the mid caps have been under a lot of pressure. If you just look at the index, and we've been down with the S&P, but the S&P growth to value ratio is still holding up as well. This could lead to a possible scenario that once all this mess gets over with, it could take us higher going into the 2024 year as we finish things out. Nothing's automatic, and we're not going to jump on this and try to front run it. That's where people are getting decimated. They're trying to set themselves up. They see a little bit of pocket of strength in the market and they get in, and then we end up still going lower. We want to wait for confirmation here that we're not getting at this time, but we're seeing the possible setups happening. And this is still looking good here. The growth ETF versus the value ETF was actually up over 0.5%. So yeah, there's still some strength under the surface here. And we went back up a little bit and we're looking solid when we compare discretionary to staples. We want discretionary to do well, and it has been doing well. It's been doing really well since we had that big down move in August. It's been the best performing sector, and this ratio is holding up. And we were down, excuse me, up just a little bit here with large cap growth, but 0.07%, I mean, virtually unchanged. But it's still, when you look at it compared to all the moving averages here, it's still in a solid uptrend. And our trend is now negative. We have the red line on top, even though it came down, but the green line's still declining. We're coming above the moving average. So this is now a negative trend, and that's what we default to until proven otherwise. And in the short term, we're also seeing above the moving average with the red line going down and the green line's also going down. That's why I say in the short and intermediate term, we're negative with the trend. We also use moving averages to reach that conclusion. And we're still picking up with volume. So that's been rather healthy lately. This is one of the sentiment gauges here, the Euphoria meter, and we're getting pretty high right now. Maybe the market was just expecting things to continue to go up, and the market doesn't like that. Well, this chart's probably out of date a little bit now because we're getting extreme negative when we look at the sentiment gauges that I follow. We're seeing an increase here with the Ulcer Index, another sentiment gauge. We're going above the moving average, which means fear's been coming back in. And we came down with the VIX, but we're still getting a very high reading here, both with the line chart and the bar chart. And this is like crazy here. The VIX of the VIX, it just, I mean, this might be some data that's incorrect here, but we're continuing to get a high reading with the VIX of the VIX. And it tends to move hand in hand. If the VIX is going up or down, the VIX of the VIX also goes up and down together. Momentum of the VIX is up, and you can see the real spike up. And we're still at 24. We're above that 20 level. And this is when we end up getting negative annualized returns, according to Tom Bowley's research. Tom Bowley is connected with StockCharts.com and EarningsBeats.com. And over the weekend, and in some of the videos I do, I'll show some research that he did that when we're above 20, there's negative annualized returns. It's when we drop below 20. So that's why we're keeping an eye on this. And it's going to really be difficult for the market to get some sustained strength as long as we're still above 20 with the VIX. And we're still getting a very high reading. This just measures how fast the VIX is moving. And it's been moving pretty fast. And this is the seasonality, though, of the VIX. And it should be going down, and it may start to go back down, but it's going up right now. And we're still getting a really high reading with the skew index, which is a variation of the VIX. They're calculated in a different way. We're up into the top end of this red area, which means the market is still expecting some kind of a big move. And even after Wednesday's decline, this went up. So maybe the market's anticipating an upward move. Well, it hasn't happened yet because we're still getting a high reading here. Then we did get the latest reading from the American Association of Individual Investors coming in right now, not just a little bit on the bullish side here at what was that 9.3, and the moving average is at 14.48. So still positive altogether, but not extreme. And we're continuing to go up with this fear gauge. We're also continuing to go up with this other fear gauge. Yeah, there's a lot of fear. People didn't expect this to happen. Perma bears, of course, they're always expecting it because they're always sure that tomorrow the world's going to end. And looking at the risk on to risk off ratio, it came down a little bit, but overall, it just shows that the bigger stocks have been holding up better than the more conservative stocks. And we went back up. Now, this was interesting. We had the big down day on Wednesday, and the equity put call ratio went down. Usually they go opposite because this is puts to calls. Puts are what people get into when the market's going down. Well, then we kind of wore that off a little bit, and the equity put call ratio is now going back up. Maybe they're still anticipating some more weakness that could be coming in. But we're still going down with the 5 day. And here we're getting an extreme negative reading with the 5 day chart. But now we're starting to turn back up with the 10 day chart. Yeah. So we're seeing a little bit of a mix there. Well, I like it when the 5 day and the 10 day are both going in the same direction at the same time. That gives us a little more confidence about if we're going down, that's positive. If we're going up, that's more negative. And then this is also interesting. We had a really high reading for the volatility risk premium. Then we had the big down day. Boom, we went to the bottom end of this range. We have an unchanged day with a lack of strength, and boom, we're right back up to another high reading again. So there's a lot of fear that the market is still anticipating, and it could end up playing itself out in price. So still seeing a deterioration here with price and volume when we look at the advanced decline line, but we're still above the moving averages. But yeah, there's some noticeable weakness, and this is another internal measure We also look at this internal measure, seeing a real expansion of the new lows and a real contraction of the new highs. This is showing some real weakness inside of the S&P. We're going down with the 5-day and the 10-day. Now we're getting close to this red line, which can quite often be the bottom here. So this is one area that it may have a little bit more weakness yet to show, but it could be setting up for things to turn positive. But we don't front run that. We wait until there's confirmation of that. And we're getting extreme negative with the short-term advanced decline ratio. We're still declining with the intermediate term advanced decline ratio. So here's where we're getting extreme based on price. We're not quite extreme yet based on volume with the 19-day advanced decline ratio. We're negative here with the smart money indicator. We're below the moving average and declining. And we're turning negative with the chicken money flow. So this is smart money chart number one. This is money chart number two. That's negative. So 2 out of 2 are negative. We look at this. Now we were trying to get a little bit of hope after Wednesday that maybe this wasn't declining. It picked up and started declining on Thursday. So this is negative. So 3 out of 3 of our smart money indicators, and that's what we want to do. We want to do what the smart money's doing, not the big money, not the hedge funds. We want to be the people that really drive the market, that really control what's going on. We want to be doing the same things that they're doing and just jump on and ride the wave with them, not going against them. This is suggesting the smart money is still negative. But under the surface, you can see pockets of potential strength at the same time. We're negative here with the vortex. The red line's going up, the green line's going down. Declining with the cumulative advanced decline line for the S&P based on price and volume. Still declining and coming down. I don't know if this is going to mean anything. If we get down to the 200-day moving average, these moving averages are on the NYSE advanced decline line. They're not on the S&P 500. And so maybe, yeah, they're on the advanced decline line. So we'll see if that ends up providing some kind of support there. But we were going sideways here with the S&P as the advanced decline one was going down. And now that we're going down with the S&P, we're still going down with the NYSE advanced decline line. And this is showing more intermediate to somewhat long-term weakness here. The 10-day average of the highs and lows for the S&P coming down, still above 50, but the context is this is declining. Also declining with the cumulative advanced decline line for the NYSE and also the regular advanced decline lines declining. Also well below the 50-day moving average and showing some weakness with this other NYSE advanced decline line. And then we break it out based on common stock, declining based on price and volume. Still below zero and declining when we look at a broad market measure of the 5-day moving average of the highs and lows. And still going up here. This means the large caps are doing better than the small caps right now. And it should be the opposite. Now, maybe a little bit later in December, but you'd think, maybe some people trying to front run the whole small cap is automatically going to go up scenario, and it still might. There's time left in December, and this can flow through into January. But right now, when this ratio goes up, that means the large caps are holding up better than the small caps. Still seeing weakness here with our advanced decline line studies, going down with the NYSE common stock, S&P mid caps, and small caps. This is another potential area that has not showing us that it's getting better, but it's getting to an extreme reading where sometimes things do get better after we see this extreme negative reading. There's 7.8% of stocks in the S&P, and I don't know how you get 0.8% of a stock that are above their 20 period moving average inside of the S&P. That's a very low reading. Now, where this comes together a little better is this study put out by Art Hill. We get down below this 10 level, and then we start to come up, and then fairly quickly after that, we get up to the 70 level. That means an upward thrust is happening in the short term. And then when that type of a thing happens, look at what the S&P did after that. And that could be quite positive. But we're not seeing that happen. This is still declining right now. We don't want to, assume this is going to happen because there may be more damage that has yet to be done before we do turn and go up. And if you get into a position and it's highly leveraged or you're buying it on margin, you may have to close out the position, even though you're right about what's going to happen. It's just you're taking such a hit in the meantime. There's a big drawdown that either you get impatient with that position or you just say, screw it, I get out. And then that's, of course, when everything turns and goes the other way. And we're also getting a real extreme reading here with the stocks above their 50-day moving average. and we're well below 50. So this is negative, ticked up just a little bit, but still 21% of stocks in the S&P. So that'd be about 100 stocks or so in the S&P. All the other ones, the other 400 plus, are below their 50-day moving average. And we're going down here, getting a really extreme reading with those stocks above their 100-day moving average. Now we're still positive here since we're above 50, but this is coming down with those stocks above their 200-day moving average. In the short term, we got these pivot point things in here, but we're still well below the 50-day moving average, and we continue to be above average with volume. And we're getting extreme negative with the 20 and 50 period moving average study just on the S&P itself. We're continuing to decline with the 200 period moving average study. And then we have our short-term indicators here. The Stochk RSI, still extreme negative. Williams percent R, extreme negative. CCI 14, CCI 20. The stochastics. We're getting extreme in the short term, starting to almost get extreme in the intermediate short term, and declining, but still above the midpoint with the short term. Stochastic still hitting the lower Keltner band here with the force index and negative. Seeing a little bit more vulnerability now with the short term trend. We're below both the blue line and the green line, and now the lines are starting to come down. And we're well below the 20 period simple and exponential moving averages. And this is a not really good looking bar here. I might try to point this out on a different chart, but we gap up, we set a high, and then we close at the low. Not a lot of confidence there. And we're still far away on the negative side. We're below the 20 period simple moving average. We're starting to cross below the midpoint here with the 50 period moving average study and going down with the 200. And we're still in the -3 channel with our standard deviations chart and just weren't really to improve that. Negative with the balance of power since we're below the midpoint. Starting to get extreme negative here with the CMB composite. I use this like an oscillator. Just a few weeks ago, we were extreme positive with this indicator. Now we're starting to get extreme negative. And we have a brown bar and a no-go with the go-no-go system. That's picking up the downward move and it's saying, don't go long right now. And still trying to catch up here with our lowest low value as we're well below the midpoint with this chart. Turning negative even more so with the TTM squeeze. And as we're been moving quickly, the standard deviation, which measures the speed either up or down, that's continuing to go up. And we're negative with the ease of movement. No change with the Iran, just kind of what? Something going on? I'm taking my Christmas break early here. I'm just going to go sideways. And now the McClellan oscillator. This is another one we've been watching. And it could be showing some signs, but we're not seeing it confirmed yet. If you look at times when this came down to a real extreme reading, you notice it was before we actually hit a bottom with price. And even though this is starting to go back up, there could be a bit of a lag here. And you can see we hit a bottom here, and then we still had a few days left to go before we bottomed here. And even in this was August. This is when the world was ending. And we even hit that a little bit early here. Well, we're starting to go back up. So this is giving us some hope. But we need to see this continue to go up. And then eventually we need to see price confirm some kind of a bounce. So we're still going down with the summation index and we're dropping below zero based on price. And we're starting to get pretty extreme here based on volume. Also with the NYSE McClellan oscillator, also you notice how we bottomed here and started to go up before price did with the S&P. So this is a broad market measure against the S&P. Well, this is at least not going down more right now. It hasn't turned to start to go back up. So we're still declining with the summation index based on price and volume here and starting to get extreme with the Swenlin trading oscillator coming down to this green line. Also still declining based on volume. Sometimes, like similar to the McClellan oscillator, this may show signs of turning up before we actually see it with price, but we're not seeing that yet. Momentum has clearly switched over to negative. The PMO is going down. We're also continuing to decline based on price and volume. We're extreme with the PMOs that are rising. We're extreme negative with the buy signals, and we're continuing to decline with the PMOs above zero. And the short-term momentum down. We're starting to cross below the midpoint. The MACD falling off a cliff here, negative, and that's more short to intermediate term. So we're going down. Short-term oscillators, intermediate term oscillators, and now we're rolling over and turning negative with our long-term oscillators. Copy curve going down, another momentum oscillator, more neutral, but the context is negative because we're going down with the Sean trend meter. And we're seeing some vulnerability now to the intermediate term trend, 50 periods. We're below the red line and blue line, and now they're starting to roll over. And we're below the 50 period simple and exponential moving averages. So we just sliced below the 20 and 50s and we're still below that level. If we continue to fall, then we're going to be keeping an eye on the 100 period moving average studies. Negative with the money flow, we're below 50 and declining. We're extreme negative here with the ultimate oscillator. Still positive, but the context is that we're going down. Now, this is an older technical analysis indicator, one of the very first ones that was developed back in the 60s. And it's crude in the fact that if we have an up day, all the volume is positive. If we have a down day, all the volume is negative. The reason I still show this is a lot of people use it, number one, and a lot of the indicators that I use get their values from on balance volume. So that's why I like to keep an eye on this one. And turning more negative here with the RSI in the intermediate term, we're getting extreme negative with the RSI in the short term. And for 2 days now, we've closed down below the lower Bollinger Band, and that usually doesn't last very long. So what's going to happen here to change that? Are we going to go back up with price, or is the Bollinger Band going to come down, or a combination of the two? And we're negative, it's still down around the 65-day exponential moving average, but negative with the Elder's Impulse system for the S&P, negative with the parabolic SAR, still declining with the bullish percent index and below 50. That's negative. Falling below 50 with the NYSE bullish percent index, and still declining with the NASDAQ 100 bullish percent index. So these are negative across the different measures that I look at. Still holding up here with the Ichimoku. Sometimes I call this the itchy and scratchy cloud, but we're still above the cloud. And that's really when I started using this chart, it was for the cloud, send in the cloud. But there's also some additional lines that come on here. We're rolling over with the blue line, and it's still barely above the red line, but the green line's coming down. So this is showing some vulnerability, but we're still above this cloud. We haven't gone in to see if this area is going to provide support. This is another thing I've been trying to point out longer term. We came up to this trend line going back to 2009, and that's about where we topped out. And now we've been starting to come back down from that line. And we're negative here with the Heiken Ashi with the black candles. We're negative with the Kegi chart since it's red and going down. We're negative with the Renko chart with the red blocks, and we're negative with the three line break. So all of our trend chart variations here, I've switched over to negative. And we're seeing a bit of a decline here with the 150 and 200. Now it's going to turn a little more negative. Notice where we came back down here? This was in August when the end of the world was coming. This is about where the market made a stand and was able to bounce up off of that. If we break down below this blue line, that may turn things a little bit more negative. This is another thing that could end up being positive, but we have to, it's like, if you play baseball, how do you catch a screwball? You wait till it stops rolling and you go over and pick it up. It's kind of that way with some of these indicators. Yeah, we see the potential for some positive things here, but we have to wait until it stops being negative and actually turns back to positive before we get excited about it. But we're getting a really, really nasty negative reading here. What we're going to be watching for, this is the ZWAG NYSE breadth thrust. When we get a negative below this blue line, which we're clearly getting now, because now Wednesday's calculated into this, there's a 1 day lag with this. If in a short period of time we can go back above the blue line and zip up to the red line, and we have 10 trading days for that to happen, that creates a ZWAG NYSE breadth thrust, and that's very positive for the market. And it's also very positive longer term. You can see other times when we had these, and then what the S&P did after that. So we're still going down right now. We have to wait until this actually completes itself. All right, then we're negative in the short term across all the different indexes, and we're negative with bonds based on price. We're negative with commodities based on price on all time frames. And we had utilities, financials, and tech were up slightly. All the other sectors ended up being down, with real estate leading things lower. And then finally, somebody went, we better update this. The trend model with the decision point scorecard has now switched to negative in the short term, but all the other time frames with the trend model are positive. In our PMO, it's the PMO where I have the additional studies. It's a momentum oscillator. That's still holding up, but I have it negative here, but they didn't change it on this chart. Saw a little bit of Christmas action here with red and blue or green. A lot of negative things right after the open. We read this from the bottom up. And then things got a little bit better in the Nasdaq, and the S&P was able to get above 5,900 there, but some follow through damage. But then you have the dollar that's been really strong, which is also pressuring stocks. The tech sector, a BPI crossed below 50. The Nasdaq had a BPI cross below 50. Healthcare, that's more defensive, had a a bearish crossover. That's when the 50 period goes below the 200 period. Staples having a BPI cross below 50, that's more defensive. And then communication, that's a growth area. We want that to be strong. And we're seeing a continued deterioration here where the S&P had been holding up while the equal weight was going down. Now they're both going down. And then we look at the ratio between the two. This just means that the S&P regular index is outperforming the equal weighted version when this ratio goes up. This is an inverse of that same thing, showing when this is going down, that means the equal weight is underperforming the S&P. And the Dow continues to, well, it was up 0.04%, but it's still below this S1 pivot point, and it lost its 50-day moving average. We're still negative with the Elder's Impulse system for the diamonds. Still seeing some weakness here, down 0.1% with the NASDAQ, but still above its 50-day moving average. Also down almost 0.5% with the NASDAQ 100, also still above its 50-day moving average. Negative with the Elder's Impulse system for the Qs. The momentum is negative for the NASDAQ 100. We're still below the 20-period moving average with the QQQs. And where's this small cap thing that was supposed to automatically happen? We're down another 3.9% here. Not looking really solid at this time, but we are extreme negative when we look at the Russell 2000 small caps. The RSI is giving us an extreme reading, but the momentum for the small caps is negative. Negative with the Elder's Impulse system for the small caps. Mid caps continue to show some weakness, down another 0.22%. Negative with the Elder's Impulse system for the mid caps. And keeping an eye on this, we were down another 0.5% with the bank ETF. The financial sector had been doing quite well. And then look at this, we're really starting to come down. And then we look at the financial sector, it dropped below its 50-day moving average. Now it was up 0.33%, but we want to get back above this 50-day moving average to turn more positive. The Wilshire, it came up, and that's acting as overhead resistance with its 50-day moving average now. And then we ended up closing down at the low. And also wondering if we can recapture the 50-day moving average with the US stock ETF. And still coming off of a recent all-time high. Just earlier in the week with the FANG index, it was up 0.33%. So this shows that the big mega caps are holding up better. But we're still below the short-term trend line, even though we bounced up 0.33%. So Apple was up 1.26%. Amazon was up 1.26%. Apple was up 0.7%. Microsoft was down 0.08%. We were up 0.06% with Google. Meta was down 0.25%. Nvidia was up 1.37%. This has actually held up better. We had the big down day on Wednesday. Nvidia was down, but only a little over 1%, and it more than recaptured that in Thursday's session. But Tesla was down 0.9% after just screaming higher. Netflix was up 1.4%. This is one of the stronger looking charts here. And seeing a bit of an improvement when we compare US to world stocks on a short-term basis. It's also improving on a longer-term basis. The dollar continues to go up in the mid 108 range now. Good if you want to do some traveling, get more favorable exchange rates. Not very positive for the stock market. They want a weaker dollar. Then keeping an eye on the semiconductors. The sector was down 1.68%. We're still down below these moving averages after generating a recent death cross. And after having Friday and Monday looking pretty good with this ratio going up, when we look at the semiconductors to tech sector, now we're coming back down again. And the market's really going to have a difficult time if the semiconductors still show weakness. Now, when we look at the ETF for the semiconductors, we're still hanging out above the 200-day moving average. So this support level is still holding. And we're still up at the higher end of this rainbow, but we've just been going sideways. We're going to need the semiconductors to really turn and burn to the upside here. And if that doesn't happen, it's really going to cause a laggard effect with the semiconductors if we do try to turn back more positive. And we're continuing to go up with the 10-year yield. We're continuing to go down with the 10-year based on price. This is a concern too. This support level has not held. When we do a ratio between home construction and the 3 to 7 year bond, the 250-day held up back in 2023 and earlier in 2024. It's breaking down below this now later in 2024, and that is a concern. But when you look at this, we're seeing some weakness here with the Qs to S&P, but still above the moving average. We're also seeing weakness, but holding up with the discretionary to S&P ratio, coming down, but still holding up when we compare large cap growth to large cap value. So the large caps, mid caps, and small caps still above their moving averages, even though they're seeing some weakness. So what's our outlook? We're still negative in the short and intermediate term. But we're seeing a really long list of oversold indications right now. We're going to get personal income and spending and core PCE, the other big inflation report of the month. And we'll get consumer sentiment, all the geopolitical things going on. We'll see if the market pays attention to them. This will finish out the calendar for the economic reports for this week. This also shows what the reading was last time, and it's going to be pretty impactful. We'll see how the market reacts to that. Seasonality, though, we're positive over the last 21 years. We're positive with the Dow, S&P, and NASDAQ. We're also positive as we finish out options expiration week, where we're up 67% of the time, down 33% of the time. And just to give you a little heads up, we're also leaning more positive the week after options expiration as well. And so you look at this, we see a little bit of positive seasonality going into the 20th, but then we chop lower a little bit before we turn and look a little bit more positive going into the end of the year. This red dashed line, that's supposed to be the small caps just going to the moon right now. In fact, they're not going that way. Friday is a very positive day, at least it was in 2023, and it's the most positive day in 2024 to this point. This is the positive seasonality that we should be seeing. This is comparing the S&P 500 from the election and then what was happening since Trump got reelected. And usually, at least it was positive last time over looking out a year after the election. And let's see, we're coming into the negative time according to Tom Bowley's research here. That's the 20th. But then once we get done with Friday's session, we do have some quite positive seasonality according to his research going into the rest of the year. And the small caps should just be going to the moon right now. They're not. They're not showing what historically has happened. So the negative side, our smart money indicators are negative. All three of them are not looking very good right now. The 10-day equity put call ratio is going up. That's negative. The advanced decline line showing weakness. We're getting extreme, but our McClellan oscillators and summation indexes are negative. Momentum is negative for the S&P. The bullish percent indexes are negative. We still have a confirmed Hindenburg-Ullman, the Vortex, the parabolic SAR, the Swenlin trading oscillator. Our moving average studies based on 20, 50, and 100 periods, those are all negative. Ease of movement, the money flow, and the ultimate oscillator, which is starting to become extreme negative, but I use that as a secondary indicator. And the momentum for the NASDAQ 100 is negative. Positive side, we're still going up with the 5-day equity put call ratio. And this is positive and under the surface. The growth to value, discretionary to staples ratios are holding up. Not showing a lot of strength, but not showing a lot of weakness either. And the 200 period moving average study, it's still above 50, but it's coming down kind of fast. The financial sector, it'll be nice if we can get back up to the 50-day moving average there. And then here's the updated chart. No additional spike here with the Hindenburg-Ullman. So our conclusion, still negative, but we're oversold, both in the short and intermediate term. We should have some positive seasonality that, at least this week, hasn't really been coming about, where the large caps and growth are still holding up for the time being. We're negative but oversold in the short term. We're also oversold but negative in the intermediate term, and the weakness is still coming in. We're not seeing much of an improvement there. We're just seeing the possible setup for improvement, but the improvements haven't actually started to happen. Where we're still positive in the long term, even though we're watching that 150 period moving average study there. Thank you. I really hope you found this helpful. Have a really great day, and I will talk to you in the next video.